Welcome to this explainer. Today, we're uncovering exactly how auditors act as financial detectives to investigate corporate records. We'll be using the ICP-AR Audit and Assurance Workbook as our guide, specifically unpacking Unit C, which focuses on audit techniques and planning methods. If you've ever wondered how auditors actually sift through absolute mountains of data to find the truth, well, you are in the right place. Let's get into it.
Here's our case board for today. We're looking at gathering the audit evidence, the science of audit sampling, targeting with audit assertions, executing the audit tests, and finally, IT and management feedback.
All right, kicking things off with Section 1, Gathering the Audit Evidence.
So according to ISA 500, that's the International Standard on Auditing, audit evidence is basically the raw information we use to arrive at the conclusions that ultimately form our audit opinion. The absolutely crucial point here is that evidence isn't just about grabbing the biggest mountain of paperwork you can find. It has to be the right amount of the right kind of proof. It demands two things: sufficiency, which is all about the quantity, and appropriateness, which means it has to be highly relevant and completely reliable.
These are the exact learning outcomes we're targeting from Unit C today. They essentially set the ground rules for our investigation. We really need to master different verification techniques, understand sampling methods, and figure out exactly how to link tests of control and substantive procedures to our main audit objectives.
Now, to actually gather this evidence, we use some very specific tools. Think of this as your detective's toolkit. We might use inspection to physically go look at an asset or examine a document. We could use observation to, say, watch a clerk process a payment. Or, and this one is my personal favorite, we can use external confirmation. That's where we go straight to the bank to verify the company's financial alibi. We also use reperformance, where we independently execute a procedure ourselves just to see if we get the exact same result. And analytical review to evaluate financial information by studying relationships and historical trends.
Moving right along to Section 2, the science of audit sampling.
Okay, picture this. You're faced with 1,000,000 transactions. How do you audit that without checking every single piece of paper and losing your mind? Well, you can't. It's literally impossible. A modern enterprise might process 50,000 transactions in a single afternoon. So this brings us to the science of sampling. Because just like a real detective doesn't have the time to interview every single person in a city, an auditor doesn't have time to review every single invoice.
ISA 523 tells us we have to choose our approach. Do we rely on statistical sampling? That's the objective, quantifiable math that uses strict probability theory to measure our risk. Or do we go with non-statistical sampling? That relies much more on the flexible, experience-based judgment of the auditor to pick and choose items. Both are totally valid, but they require very different strategies to keep our overall audit risk down to an acceptable level.
Depending on the approach we take, we use different selection techniques to isolate our targets. We might use random sampling, literally giving every transaction an equal chance of being picked, or systematic sampling, choosing, say, every 10th item. A super powerful tool we use a lot is stratified sampling, where we group high-value transactions together for closer scrutiny. Now, shifting away from the strict math side, there's haphazard sampling, which is based entirely on auditor judgment, and cluster sampling, where we select whole entire blocks of data. The end goal, getting a sample that accurately represents the whole population.
Which brings us to Section 3, targeting with audit assertions. You see, when management hands over those financial statements, they aren't just giving us numbers. They are making specific claims. We call these assertions. We map them out to ensure we're testing exactly what they're claiming. For example, for a transaction, we want to verify a purchase actually occurred, or that their revenue is completely recorded. When looking at account balances, we're checking for things like existence, is that inventory actually sitting in the warehouse, and valuation. Using this framework ensures our investigation is laser-targeted to spot potential misstatements.
The core philosophy to remember here is this. If your procedures aren't directly linked to assessed risks, you are quite literally spinning your wheels and wasting investigative time. You have to follow the risk. Your audit effort should always be focused on the risk of material misstatement that you identified way back during the initial planning phase.
Let's move on to Section 4, executing the audit tests. Armed with our evidence rules, our samples, and our targets, it's time to actually execute. We split this attack into two distinct phases. First, tests of controls. This is where we evaluate if the company's own internal security and checks are actually doing their job to prevent errors.
But listen, regardless of how amazing those controls look on paper, we still have to perform substantive procedures. That's the aggressive, detailed hunting for actual material misstatements hiding inside the transaction numbers and the account balances.
So what does this look like in the real world? Well, for a test of control, we might stand there and observe a clerk to ensure they're properly signing off on travel claims. But then we shift gears for the substantive testing. Here, we might run some hard trend and ratio analysis, maybe comparing their current payroll numbers to industry benchmarks, to substantively prove that the final financials actually make sense in context. It's a classic 1-2 punch. Observe the process, then ruthlessly analyze the data.
And it all follows a beautifully logical workflow, from identifying the assertion and the risk right at the top, testing the controls, running our substantive tests, and documenting every single thing in our working papers, all the way down to that final sign-off by the audit engagement supervisor.
Finally, let's look at Section 5, IT and management feedback. Look, nobody audits with just a pen and paper anymore, right? Modern financial detectives are navigating complex IT environments. This means we have to distinguish between and test two different things. First, the broad security protocols, the general IT controls, like password policies and physical server access. And second, the application controls, the specific, granular rules governing exactly who is allowed to enter or alter data within the accounting software itself. Now, throughout this entire process, we are relying heavily on management's word. But here is a massive red flag. If management flat out refuses to sign a representation letter confirming their claims, ISA 580 tells us we have to immediately reevaluate their fundamental integrity. If they won't put it in writing, you have to seriously question how that refusal impacts the reliability of every single other piece of evidence you've gathered so far. So, we've gathered the evidence, we've navigated the sampling math, and we've hunted for errors deep inside the IT systems. But I want to leave you with this thought. Since we only ever provide reasonable assurance and never absolute assurance, and since sampling relies on probability and management ultimately holds the keys to those final representations, is any audit ever truly 100% foolproof? Or, at the end of the day, is your ultimate, most powerful tool simply your relentless professional skepticism? Something to think about. Thanks for joining me on this deep dive into audit techniques. Keep questioning and keep learning.